Now, taxation of cross-border activities. Taxation of cross-border activities. So taxation of cross-border activities, we say this arises when a Kenyan resident earn some income from foreign countries, from a foreign country, earn some income from a foreign country. Full stop, then you say double taxation treaties stroke agreements will always be relevant in such scenarios ama circumstances. Double taxation treaties stroke agreements will always be relevant in such scenarios. Then you can, next point to say, these are, so defining what double taxation treaties are, these are bilateral agreement between Kenyan government and the foreign government. Kenyan government and the foreign government to protect their respective citizens from double taxation. So it's meant to protect the citizens from being taxed in Kenya and also being taxed in the foreign country. Next point, a double taxation relief would be granted. A double taxation relief would be granted under three conditions. Will be granted under three conditions. Condition number one, there must be a double taxation agreement. There must be a double taxation agreement between Kenya and that foreign country. There must be a double taxation agreement between Kenya and that foreign country. Number two, the taxpayer must be a Kenyan resident. The taxpayer must be a Kenyan resident in that year of income. They must be a Kenyan resident in that year of income. And number three, foreign tax in Kenya shillings foreign tax in Kenya shillings must be more than foreign tax in Kenya shillings must be more than tax paid in foreign country. The foreign tax in Kenya shillings must be more than tax paid in foreign country. So hiyo tax ambayo unafaa ulipe Kenya on that foreign income inafaa ikuwe mingi compared na ile tax ulilipa huko. So inamaanisha kuwa when you maybe looking at a foreign country like maybe Uganda wamekucharge tax ya maybe 5,000. In Uganda, an equivalent of Kenya shillings 5,000 was paid in Uganda. Then on that very income we come in Kenya and calculate the tax, and in Kenya we discover that ile tax unafaa ulipe ni Kenya shillings 7,000. And this is the tax that you're supposed to pay in Kenya on that foreign income that you earned in Uganda. So in such a case, you shall say, okay, sorry, out of the 7,000 that you're supposed to pay, you've already paid 5,000 in Uganda. So only pay the difference, which is 2,000. So a double taxation relief will be the 5,000. So only pay the excess. Tunasema kuwa kwa ile pesa unafuu tulipe Kenya 5,000 kwa hiyo income, ushalipa Uganda 5,000. So wewe tupe tu hiyo difference yenye imebaki. But if there is no double taxation agreement between Kenya and Uganda, then we'll not consider the 5,000. You already paid 5,000 in Uganda. When you come to Kenya, you calculate our tax, you're supposed to pay 7,000. So you suffer twice. You suffer twice. But if the foreign tax, yes, Richard.
My question is, so this 5,000, calculating the amount of tax to pay where in Kenya, will they use the net amount that you have been paid, or will they use the gross that was on the other side? Assuming it was an invoice, will they use the invoice, the gross amount on that invoice?
Tax is never calculated on another tax. Tax is always calculated on the profit before tax, or the income that you earn before tax. So it's always on the gross. So we the tax system of Kenya is very different from the tax system of Uganda. That income, a Kenyan resident earning income in Uganda, we always say that income is assumed to belong to Kenya for tax purposes. Hence, it's supposed to be taxed in Kenya. So in Kenya, we calculate the tax regardless of how much you paid in Uganda. Ile income ume-earn huko ni ngapi? 50,000. Kwa hiyo 50,000 sisi kama Wakenya tunataka tax ya ngapi? Tunataka tax ya 7,000. Then we stop there. We now go to the next step. Out of the 7,000, has the Ugandan government confirmed that you paid some taxes there? Yes, there's a double taxation treaty. We can confirm that. We confirm. The Ugandan government confirms that yes, in that 50,000 that he earned in our country, we taxed him 5,000. Then now it goes back to us and say, okay, out of the 7,000 that is taxed on this income of 50,000, Uganda, he has already been charged 5,000. So let us not double charge him. Let us not double tax him. He only gives us the difference of 2,000 so that eventually he has paid a total tax of 7,000 and not 12,000.
Okay, that's good.
Great. But again, if in Uganda you had paid 5,000, then when you come to Kenya, which is mostly not the case, Kenyan tax system is known to be one of the highest. In Kenya, you're supposed to pay 3,000. Then again, in the same spirit, we shall tell you that, look here, you're supposed to pay us 3,000, but in that foreign income, after earning that income, you already taxed 5,000. So don't give us anything and don't claim anything from us. So you end up paying the 5,000 instead of 8,000. And that's why we said the Kenyan tax on foreign income must be more than the tax paid in foreign country. So if the Kenyan tax on foreign income is less than the tax paid in foreign country, then you don't enjoy any relief from us. We don't reduce your liability. You already paid it. We forget about you, but we don't charge you anymore. Hi. So let's I've just seen there's a question on our right hand side. This is question 5C. Question 5C of December 2023. December 2023, question 5C. So Alessia Gosselin was resident in Kenya. See how they put it? Was a resident in Kenya. So he meets the first condition. During the year ended at 1st December 2022, she has provided the following information on her income, both from Kenya and country Z during the year ended at 1st December 2022. Kenya and country Z have signed a double taxation agreement. So there's a double taxation agreement from Kenya and that foreign country. So the condition number 2 is there. Then we are told income from country Z, employment income from country Z was ZX 72 million, pay in that country was 9 million. The applicable foreign exchange rate was one Kenya shilling for 30 ZX. So you can convert and get the equivalent Kenya shillings for both income and pay. Income from Kenya, basic salary 202,800, net of pay. It's net, you always add back. Ni kama tulize dividends ikuwa net net, we always add back the withholding tax. Taxable income must always be gross. So add back the pay to make it gross. Subsistence allowance, that is per diem, for 10 days that she worked out of office. Taxation of per diem, from the baby class perspective or industry, I don't know. The first 2,000 per day is exempted from tax, so it tax the balance. Then we have no. Sorry for that. So per diem, the subsistence allowance, we tax the first 2,000 for each day is exempted from tax. Medical allowance of 40,000 per month in respect of a policy that covered all employees. Now the government discourages discrimination. The medical benefit. The medical benefit. We're not looking at the medical allowance, the medical benefit. Uko na medical cover ya staff. And you're not having it as an allowance, whether uligonjeka ama kugonjeka utai-earn. But the medical cover or the medical benefit you're talking about, nile, you only enjoy upon medication. That one will always be free of tax, tax exempt, as long as it does not discriminate. Like in this case, it covers all employees. The only challenge is that is a medical allowance. Medical allowance is fully taxed because you'll enjoy it whether umegonjeka ama hapana. That is guaranteed on monthly basis. But the medical benefit you're talking about, you only enjoy it upon medication. Hiyo ndio inakuanga na condition kuwa if it is non-discriminatory, then everybody enjoying it will be enjoying it free of tax. Commercial property rental income for the year of 2.4 million after deducting cost of partitions. Partitions go to capital allowance. It had been deducted, shall add back. Mortgage repayment. Mortgage repayment is capital, we shall add back, but we need to less the mortgage interest, out of which 120 was mortgage interest. So shall add back the difference, the one that is for the mortgage. And agent fees of 180,000. Agent fees is allowable. So it was deducted, we are good with that. Interest income from Mujengo Company Limited of 405,000 net. So interest, this is an individual receiving the interest. The interest that will affect us is always sorry, if it's the company receiving the interest, but this is an individual, Alicia. Compute double taxation relief due to Alicia for the year 2022, the net tax liability. So let's see, let's have that. We say we deduct the Kenyan tax on Kenyan income. We deduct the Kenyan tax on Kenyan income from the Kenyan tax on total income. We deduct the Kenyan tax on Kenyan income from the Kenyan tax on total income to get the Kenyan tax on foreign income. To get the Kenyan tax on foreign income. Full stop, then you say double taxation relief will arise. Double taxation relief will arise only if the Kenyan tax on foreign income, only if the Kenyan tax on foreign income is more than tax paid in foreign country. Only if the Kenyan tax on foreign income is more than tax paid in foreign country. So let's see this. Let's have Kenyan income, Kenyan taxable income. So we have basic salary. Basic salary. So we are having 202,800 plus 37,200. And that was monthly, we multiply by 12. So that is basic salary. Let's see. We have subsistence allowance. Subsistence allowance, sometimes called per diem. So per diem watu wengi huibia serikali but only exempt to 2,000. Wengi huilipa kama imprest. Wana end up kutoiconsider kwa taxation. So subsistence allowance, the actual walisema subsistence allowance 14,000 per day for 10 days. So actual is 14,000 times 10, which equals to 140,000. Then we have exempt. So to exempt 2,000 per day, so times 10. So 2,000 times 10, that is 20,000. So we tax the difference, and the difference is 120. 120,000. Medical allowance. It's not a medical cover. So this is an allowance. Allowances are fully taxed. So 40,000 per month. So that is 40,000 times 12. 40,000 by 12. After medical allowance, so you have employment income. From employment income, we have that. We bring in other incomes. We have rental income. Mesema ni commercial. Kwa hivyo hakuna cha kuangalia sijui 15 million or what have you. So it's a commercial building. So I'll receive rent ya 2,400 or 2.4 million. For the year of 2.4 million after deducting the cost of partitions. So we add back partitions. Partitions had costed 460. So add back 460. We also have mortgage repayment. And the mortgage repayment, out of the 540 kuna interest ya 120. So you add back the 540 minus 120. So equals 540 minus 120. We add back the 420. Agent fees iko sawa. Then we shall less the capital allowance. Capital allowance, in our case, we had the partitions. Partitions tukiangalia kwa leakage, if you can recall, ilikuwa 10%. So 10% of 460. That should be 46,000. So you have the rental income. So equals to sum of these. That's for a rental income. We also had some other income, interest from mjengo. Interest from mjengo. So hapa lazima tuweke tu dash. It's not an individual receiving that interest. It's an individual receiving that interest, is not a company. Interest must be received by a company for it to be kwa other incomes. Otherwise, this is an individual. The individual need dividends from cooperative society other than a SACCO. So you have the total, the taxable Kenyan income, which is the summation of that. So employment income tuko nayo hapo na tuko na hiyo. Good. Haya. Then we bring in foreign income. We bring in foreign income. So from that country Z alipata 720, pay was 9 million. Wajasema net of pay. They've just highlighted what pay is. It's always gross unless otherwise stated. Unless wakupe some information that will make you confirm that that pay had been deducted. Otherwise, it's always gross. Wakimention tu pay na wajasema ilitolewa, then usi add back haijatolewa. It's always gross. So therefore hapa tuko na we convert to Kenya shillings, so 72 million. I believe it's 1 Kenya shilling for 72 for 30 foreign zain. So 1 Kenya shilling divided by ZX30 times ZX 72 million. So that ZX and ZX can cancel out.
Ukifanya tu direct 72 divided by 30 and then hapo uweke the figure. Will there be an issue?
No, it's very okay.
Okay.
It is very okay. 2.4 million Kenya shillings. So we have total taxable income, which is again the summation of that. So you have the total taxable income there. Now, at that point, we look at the total income. We can have here as a Kenyan income. Na huku tukuwe na total income. So we need tax on. We have the total Kenyan income and the total income. And we now go to this is an individual, so we tax graduated scale rate. Graduated scale rate iko kwa leakage. Let's see, let's use the one that we shall use in the exam. So here. So out of the 9.1 million, so remember Kenyan income is 6.7, ingine 9.1. So out of the 9.1 million, we tax in bits. The first 288,000 we tax at 10%. So first 288,000 tunaichapa na 10%, as you can see there. So hapa tuko na 28,800. Huku kwingine pia tuko na 28,800. Next, the next installment, the next bracket, graduated scale rate, is from 230 to 288 to 388. The difference is 100,000. So you have the next 100,000 na rate yake wanasema tuichape na ngapi? 25%. So 25% of 100, that is 25,000. Hii pia ni 25,000. Tunaenda ya tatu. Ya tatu inachukua mpaka 6 million. So from 388 to 6 million. Kiangalia income yetu ya Kenya ni less than 6, ni more than 6 million, kwa hivyo it's covered. So what is this range? 6 million minus 388, that is 56, 56, 56, 5612 should be the difference.
Yes,
So the
it's
next,
correct.
good. So it should be 5612,000. Na hiyo tunaichapa na 30%. So you have that there. So 56,000 times 30%, which is the same as this one. Then now after that, we look at the balance of tax. Balance, or the balance. On the Kenyan income,
Was it a 56,000 or 5612?
it's 5612, right?
Yeah.
Thank you. 5612,000, right?
Yes.
5612 toa 01.
Yeah, like that.
Good, thank you. Now the balance for the Kenyan income, we had a total of 6714 to tax, 6714,000 to tax, but we've only taxed up to 6 million. So the difference tunaichapa na 32.5%. So at 32.5%. The new side ingine, total is 91 na huku inaenda mpaka 96. So it also covers, we need also the difference. So the balance in our case, we had a total of 9114. 9114. That share tax 6 million. Na hiyo tunaichapa na 32.5. So the same concept. So therefore, we have the gross tax, which is the total. Gross tax is the sum.
Hiyo ya mwisho ya 9 million is a total.
Yes, total income.
Oh, no, hiyo balance ya line 31. 9 million minus 6 million.
9 million minus 6 million. Cha tuangalie. 9114, right?
So that is the income from
The
that is the total.
total income. Total income. Kumbuka hapa ndani kuna Kenyan income na foreign income. So you take the total. Okay, let me continue so that it makes sense. Then after taking the total here, you appreciate kwa hapa ndani hata hii iko. Because this was tax on total income, and total income is both Kenyan and foreign. So therefore, we come and less tax on Kenyan income. Tax on Kenyan income, which is this. So we come and less here. So that now the difference becomes the Kenyan tax on foreign income, which is this minus this. Then now having done that, we come and ask ourselves, what was the tax paid in foreign country? Tax paid in foreign country. So the tax paid in foreign country was going back there. Has happened. It was 2023. So the tax paid in foreign country was 9 million. So 9 million divide by 30. So you can see the tax paid in foreign country is less than the tax payable in Kenya on that. Now, as we are saying, on that foreign income, you're supposed to pay tax of 780,000 in Kenya. But when you look at the tax you paid in foreign country, you paid 300,000. And only this explanation appreciates that there's a double taxation. So after analyzing that, we come back and tell him that now double taxation relief yenye walisema to calculate equals Kenya shillings 300,000. So you are given a relief of 300,000. So hiyo inakuanga ushaijua. You see, you can get it very direct without even doing this mathematics. But the max is in this confirmation. So you need to confirm first that yes, you qualify for this relief, because the tax you're supposed to pay in Kenya on that foreign income is more than the tax that you already paid in that foreign country. Hope that makes sense. Now, part 2, they asked about the net tax liability. So you can talk about tax liability. Tax liability. So you have the gross tax. Gross tax on total income. The gross tax on total income was this one. So hiyo ni tax yenye unafaa ulipe kwa income yako yote yenye ume-earn. Then we come and ask ourselves, out of that amount, sasa mpe ile relief. So you less double taxation relief ambayo ni 300,000. I put it here. Alikuwa na pay relief. Those pay that had been deducted ya Kenyan income 37,200 times 12. 37,200 by 12. So 37,200 by 12 shall give ourselves that relief. He's a Kenyan resident, so he qualifies for personal relief. Personal relief, you don't have to cram it in kwa leakage. Kwa leakage 28,800 if I'm not wrong. So inakwanga hapa tu juu yake 28,800. Pia kuna withholding tax relief. Kama tungekuwa nayo in our case, the withholding tax relief haiko, the interest that was there was not subjected to further taxation. I think that is it. So this one is not there. So therefore we have tax payable, ama tax liability, which will be this minus this. So hiyo ndio tax yenye amelipa kwa income zake zote, both in Kenya and in country Z. Any question? Ko sawa?
Sina ni swali hata limoja.
Ndanu?
No, I don't have any questions.
Great. So